gives you the visibility of your borrower's financial know-how. GSTR Analyzer analyzes the raw data available on GST server and gives insights on the various sale and purchase transactions to the lender. Digital lending software platform originate loans and is powered by SCORME APIs for determining loan eligibility using analysis across financial statements. Credit monitoring highly flexible and scalable software, enabling the lender to analyze large volumes of data as per requirements. SCORME, a leading fintech company in India. Get in touch to know more.
SCORME Solutions and Resurgent India presents a virtual session on how are Fintech and NBFCs tackling recent regulatory shifts. Moderator Mr. K. Gupta, Director, Resurgent India Limited. Eminent speakers Mr. Madhu Srinivas, Partner, Scienzy. Dr. Jasmine B. Gupta, Founder, Mate Money. Mr. Sudeep Mondal, Founder, Startafolic Catalyst. Mr. Keshav Rao Avani, President Digital Banking, Yes Bank.
Good evening, friends. I am your host, K. Gupta here. I am a director in Resurgent India. And we welcome all my eminent speakers and all the participants. We have more than 800 registrations with us. And this is SCORME. The webinar is 36 webinars. And we have conducted webinar of 212 under the banner of Resurgent India. And we are another association with us, the Association for Financial Advisor of India, where we are also doing, we have done about 34 webinars. Overall, around 300 webinars we have conducted under the banner of Resurgent India and our associates. We are also doing some webinar with the different chambers. And today also one webinar of Indian Chamber of Commerce, which I have attended. So this webinar has its own importance because all the participants are aware that Reserve Bank of India recently increased the risk-weighted assets by 25 basis points. So if you go before the COVID period also, it was also the same because of the liquidity. So Reserve Bank has reduced the risk-weighted assets by 20 basis points. You can still, when we are seeing the growth in respect of the personal loan and also for the unsecured loans, when we are seeing the 22 August, it was growth of 19.4%, where year-to-year growth on 23 was 30.8% of the personal loans. When we are talking about the amount lent, in August it was lent by 36.4 lakhs crore rupees, and up to August this year, it was 47.7 lakh crore rupees. Whereas we are talking about the overall growth in the banking sector of the credit is 12 to 15%. Now it is expected that this financial year ending March 24, it may go to 13% vis-a-vis to 14%. When we are talking about the NBFC, the growth of 2022 was 30% of the unsecured loans. Like now we are talking about 23, it was 51%. So that's why Reserve Bank has come out to increase the risk weighted. How the risk weighted will going to affect the onward lending to a customers? Because we are talking about the digital banking, online banking, where the 50,000 and less are being sanctioned, including by the State Bank of India and other peoples over the internet. We are going to discuss in a details how it is going to play and what will be effect of this increase. So I'm coming first of all. I'm requesting Shri Mr. Keshav Rao. He is Avani, President, Digital Banking, Yes Bank. He is representing the bank, digital banking. So first of all, as a banker, I want to know how the KYC is done by the fintech company. Have any view on that, Mr. Rao? Because KYC has to be done by the banks, by the NBFC before entertaining any customers. And how they are maintaining the KYC, Mr. Rao?
So, fintech companies also perform the KYC in a much similar fashion as what most of the banks do. Though there have been some regulatory, fintechs often navigate evolving regulatory constraints on digital payments when compared to the norms of a bank. There are certain uncertainties in the fintech with respect to the implementing the KYC infrastructure compared to a bank, but they pretty much do the same kind of KYC with respect to what we are doing inside a bank. Though there is a slight difference in how they navigate the KYC piece. Why do they struggle while we don't struggle? While traditional banks have robust, systems in place, why do fintechs often negate the focus on KYC? Something which we can definitely look at. They're more startup focused. They're focusing on growth and innovation and are driven by investors. So they look at faster outcome rather than a very long-term situational understanding what incumbent banks have more or less. The other piece, I think, where the fintechs are focusing, have to focus is on the technological integrations, because in integrating for fintech platforms into KYC system become complex, because even KYC also keeps evolving. Previously we were looking at documents, then it became e-verifications, then it became kind of a digi-lockers, and then there's video KYC which has come into the picture. So fintechs also keep evolving with the banks, and there's a cost associated with it. There's a cost constraint which I think the fintechs also have to take into play. And the other piece fintechs also look at is data sharing element, which there is a RBI has always been clear that the data sharing limitations and checks on the credit bureaus and other pieces actually are hindering the KYC effectiveness as to how fintechs are looking at KYC, while they're taking the shortcuts. There's a trade-off on how fintechs are doing it. They're focusing on ease of use and customer experience as a priority, primarily driven because of a segmentation of each fintech. They look at one domain and then they try to excel in that, while a bank has to look at a much larger landscape. And fintechs have a very evolved sense of how to onboard a customer, while banks have different. So what I wanted to give you a perspective was that, it's a blanket statement. I said it before also. It's a blanket statement that all fintechs try to take a shortcut. No, it is not. There are many fintechs who are doing good job with respect to KYC. It's just that RBI is becoming more cautious and fintechs are just coming under the radar of the regulatory purview at this point.
Mr. Rao, you are a authority in creating concept to market and also digital transformations. So whether this KYC cannot be done on digitally, because now systems are available where you can fetch the data from Aadhaar card, from a bank account, from GST, everything you can have. Why such thing is lacking in an fintech company? Because they are expert in that field. So why the KYCs have some, they couldn't maintain properly?
So, I mean, it's a trade-off. Again, as I said, I mean, it takes integration efforts, it takes cost, it takes a lot of, I mean, it's the KYC process also hinders with the user experience, the kind of neo user experience, the Gen Z feel that fintechs are looking at. Unfortunately, it is not about making it completely digital. There are ways where we can do it completely digital. Many of the banks are doing it. Many of the small finance banks, payment banks have also ventured into a similar note. It's not about integration and the technology piece. I think that is that can be met. It is about nitty-gritties of regulation. Like if a person has a same PAN card being used for multiple people for doing KYC. How do you regulate that? How do you do data protection around that? How do you ensure that the anti-money laundering or the financial crimes are being curbed? That's the kind of questions which RBI will ask. I think fintechs are pretty much there. The landscape and the infrastructure inside the country, India Stack and other pieces are also pretty much there for us to be able to do digital KYC. Even for the business sectors, I mean, the SME sector, MSME sector, and others also are slowly coming into the digital KYC piece through e-Udyam and Aadhaar pieces. So I think it's not about tech, it's more about the intent and how the data manipulation and other pieces are being covered.
You're right in that respect. Like data can be used from UK source. They can collect from the source. You're talking about the PAN card, they can collect from the source. Aadhaar card can be collected from the source. And it can be utilized by as many people as possible. There's no problem in that. Thus, I'm coming to this Visa card
Yes.
and MasterCard. I think they are mainly used for the business payment. When we are talking about the rent payment, we are talking about the vendor payment, they are being used. So why now with the RBI directive, how it will implication will be there for this credit card holder or the, you can say, issuer of the credit card?
So I think what you're trying to refer out here, what we are all trying to understand out here rather, is the restrictions that RBI has posed on Visa and MasterCard for stopping their business payments process services.
Yeah, this is a directly question. This is a directly question.
Correct. So, I mean, the fundamental reason for RBI always to do something like that is on 4 counts. One, which is a KYC, where RBI suspects non-compliance of KYC norms by these fintechs who are using Master and Visa's platforms for money laundering and financial crimes. The second one is these same kind of transactions are being are happening with merchants who are unauthorized to accept commercial card payments or I mean the payments in such formats, and that raises concern because that's a complete what do you call it's like bringing down a complete payment structure and infrastructure inside the country. The third aspect I think is a regulatory clarity. Before RBI brings in a clarity, it always does a stopgap arrangement where it says, I don't want you to do certain tasks till I give you a clarity. And I think today's circular, as we speak, I think it pretty much clarifies that they don't want the business, process, business payments services provision from commercial cards for merchant payments on credit card networks. I mean, rather card networks. And the fourth aspect I think RBI looks at is data security. I think it is because fintechs data security practices are not as regulated as banks. They think the sensitive financial information may be compromised. And all of this will definitely add into the possible implications that we will look at. I mean, the implications will be disruption in business. The companies who are using these fintech services or the networks for making these B2B payments will have a setback. There will be compliance pressure which will come in. I mean, fintechs will start seeing compliance pressures on improved KYC, as well as merchants will also be forced to comply. And the first stop is by making sure networks do not allow them to do these transactions. Then you will see an implication in innovation slowdown. Fintechs have a tendency to do sprints instead of marathon. So you will see a slowdown there. The B2B payment space, the fintechs who are looking at it will, their whole functioning will hamper a little bit till the regulatory uncertainty closes out. And the last piece,
Yes.
which will be a very game changer out here, is the constant regulatory supervision by RBI on the network as well as on the fintechs out here. It sends out a statement to the investors' confidence. So it's a kind of a very speed breaker for fintechs at this point of time in the fintech sector. But I mean, at the end of the day, what RBI is trying to do is it's trying to push out possibilities of financial crime or how should I say, the AML scenarios, and push it towards more regulated pieces like RTGS or NEFT.
So as a yes back, so for credit card business, so how much hit will be you are having by increasing the provision of 25%?
No, I really can't comment on that because it's more to do with the fintech market. RBI's regulations are more to do with fintech market. Commercial payments will continue as is. They may take up alternative payments on the net banking side.
That's I'm more interested to get that answer. Thank you very much, sir. Thank you, Major Rao.
My pleasure.
Excellent, excellent. Now I'm coming to Dr. Jasmine B. Gupta, founder, Meet Money. Welcome, madam. I've seen your profile. I think
Thank
it
you,
is
sir.
excellent.
Glad to be here.
So you are a triple gold medalist in MBA. You have done PhD in financial inclusion and digitalizations. I think this is my major subject for that. Madam, you have just seen the regulations. What is the Reserve Bank has come out? Risk-weighted assets. So they have to increase the provision. That means capital has to be introduced. So that means 25% further the capital is required by the banking sector or the NBFC also. So you feel that for a new credit, this regulatory change has any effect?
Of course, it has an effect for the customers because
How?
ultimately the cost is passed on to the borrower. So when the cost of capital rises, ultimately it is the borrower whose interest rates are going to rise. But I feel new to credit customers have a lot of things to gain also. While increasing risk weightages is one thing that the regulator has brought in, I think that there are a lot of other positives that the regulator has brought in terms of streamlining the entire digital lending landscape. The relationship between the lender, the regulated entities, the banks, NBFCs, the fintechs, and the LSPs. And I think this streamlining of landscape is in favor of the customer because, for example, now the key fact sheet has become mandatory for all the lenders to provide to the customer. Now, imagine a new to credit customer who is going through the loan agreement, which is so long and lengthy and complicated. It's not easy to understand, right? But then, with a key fact sheet, which is now made mandatory by the regulator, it is very easy for the new to credit customer to understand, okay, these are the terms and conditions and these are the rates. This is the annualized rate. This is how I need to go through the grievance process. So I think the entire process and the regulations that have been set is definitely in favor of the borrower. While, of course, I think RBI is sensing that this increase in unsecured personal loans is something that needs to be tightened, and hence the risk weightages have been increased. But at the same time, the other regulations that have been brought in terms of grievance redressal also, where even if the fintech or the loan service provider who is providing the service on behalf of the lender has also to appoint a grievance officer and to provide the information across all the apps, right? So all of this transparency, all of these disclosure norms make it very easy for the customer to understand what he is getting into. And I think it's a win-win for the customer, wherein while it is the lenders also strengthen their credit evaluation mechanisms, because now the cost of this capital is high. At the same time, the borrowers also benefit in terms of the transparency, the disclosure norms, and the consent, which is the most important part, I think, which has been brought in by the regulator. Nothing can be taken from the customer without the customer's consent, and I think that is very, very important. And all the digital lending apps which had created a lot of bad loan or bad apps kind of problems in the country, I think most of them have been wiped out once this consent has become so important, right? So I think the way we look at it, the new to credit customer uh, have positives and negatives both.
Both way it will be negative and positive also, what you're
Yeah.
talking about. Lekin the era was mobile banking, or you can say internet sanctioning of 50 lakhs, 50,000 rupees, you can sanction on that. That means soft credit are being given by the NBFC, by the banker also. You feel that why this regulation, this soft approach of the bank will not be there.
Sorry, so can you repeat the last part of your question?
My point is, soft loan are being provided up to 50,000 rupees, nothing else. You send on the system, they will give you sanction. Even documentation can be done immediately. So why this regulation? By increasing this, you can say risk weighted. So whether it will be going to affect something?
Definitely, I think it's going to affect it because uh, we have seen there are lots of offers that keep coming in terms of pre-approved loan ले लो, offer है, एक पे एक ले लो, top up ले लो. I think all of these are going to stop. Most of the loans, even when they are offered digitally, will go through the entire rigorous KYC process, because now I don't think whether it is an NBFC or whether it is a fintech or a bank can afford to make a wrong decision or to get a wrong customer in the place. So I think while the entire journey may become digital, the approach may be a digital approach as well as a phygital approach also, uh, as may be required on a case to case basis. So, for example, while the KYC and other verifications can be end-to-end digital, the in-person verification or the video verification or the tele-verification can be brought in to make it a digital approach so that the evaluation of the customer is also proper. So I think ultimately everybody has realized that while we want to do fast business, we definitely want to get the right customer in, because getting a wrong customer in is what is impacting the balance sheet. And now I think because the onus is on the regulated entity, I think because fintechs are not regulated by the regulator, the kind of indirect regulation that has been brought in by RBI through imposing a lot of rules and regulations on the regulated entities makes it possible for the regulated entities to first determine which kind of LSPs that they do business with, which kind of fintech partnerships they look at. Because in a co-lending or a partnership model, it is very important even for an NBFC to definitely be sure that the fintech or the LSP that they are doing business with is also following the norms that are prescribed by the regulator. So I think the partnership evaluation along with the evaluation of the borrower is important. So I think all of these things and the new changes that have brought in are definitely going to impact the way digital lending landscape is being played out.
Madam, what you're talking about is why increase of 25% as a risk weighted. such thing will happen. All KYC compliance was there, compliance was there, everything was there, inspection was there. Everything was being done by the fintech company and by the NBFC. What are talking about the co-lending also. That also been by having the increase in capital. So you feel that it is a stringent instruction by the RBI and this you can say borrower will be have much more control. You feel like that?
It's not just about increasing the risk weight, it's also about taking into consideration a lot of other regulatory changes that have been announced. So I think it's a combination of one, which is increasing the risk weight, which is going to have some impact. Also,
I'm just proving
the
you.
regulatory
Let I to
norms that were
understand.
announced in
Let I to understand properly.
2023 last year. I think that
Okay.
also combined with these regulations will have an overall impact.
Okay. Thank you very much. So I will coming to you again. Now I'm coming to Sudeep Mondal. He is a founder of Start Eupolic Catalyst. Sandeep is a skilled and optimistic individual currently working in fintech and credit risk domain. He has expertise in financial analysis, financial accounting, credit risk management, risk. So many risk you are sir, looking into, Mr. Mondal. So just I want to know why RBI intensifying its focus on non-compliance will have any effect on the growth of the uh, sector, growth of the credit, or alternatively, what do you suggest it should be done? Because everybody talking about the growth will be hampered, other thing will be hampered, capital will be required. Definitely, capital is required. Lekin by increasing the 25% risk weighted, which is I think before COVID also, it was 125% before COVID. Now COVID ke baad they have reduced it to 25%. So how you feel like that? You are a risk person and dealing with all the risk management, credit risk management you are also looking into. Have any view, Mr. Mondal? Mondal sir, अनम्यूट कीजिए सर, अनम्यूट कर लीजिए अपना. हाँ प्लीज, मंडल साहब प्लीज.
I think Paytm crisis might be blessing in disguise for the entire ecosystem.
Okay, sir.
Because now the entire ecosystem is talking about Paytm crisis, but it has been long coming from the RBI. Because in the previous two occasions during the Global Fintech Fest, Mr. Shaktikanta Das has clearly spoken about the compliance and regulatory for the fintech ecosystem. So he has spoken about two positive points, that we are here to support the entire ecosystem. But again, on the other side, fintech ecosystem has to comply with the regulations and the other regulatory thing from the RBI. So now he has also spoken about the creating their own SRO for the fintech ecosystem, so that they can have their own regulated entity, like self-regulatory organization, where this kind of situation can be taken care of internally between both the SRO and the ecosystem, like what has happened with Paytm. So this can be escaped going forward while setting up this SRO for the entire ecosystem. Because for the regulators, it is always the customer first. And with the entire sector is getting digitized and is evolving day by day, it is also difficult for the customer also to get a understanding about what is happening digitally. Because at the ground level, we have seen a lot of customer finding it difficult to, like, they are taking money from the multiple lenders, but ultimately for the repayment, when they are repaying for that particular loan, they are getting confused. Who is the actual lender? I think there's a very loopholes into that ecosystem. And I think from my point of view, RBI is right to asking fintech to comply on that part also. And from the KYC also, if there is any loopholes on the multiple loan is getting disbursed on a single PAN card, multiple customer is getting onboarded on a single PAN card, again, that is not good for the entire ecosystem. And On the other side, like when we talk about the fintech ecosystem, yes, there are very good fintech who are doing pretty well, and they have been the torchbearer of the entire ecosystem, including Paytm and other big players. But on the ground level, I think it is very important for the fintech founders because it takes a lot of toll to build a ecosystem, and like you are taking that risk, you are leaving out your job, and you are taking that kind of risk, and you are building kind of an own ecosystem. So that is where I think time has come for the fintech ecosystem to not only be product market fit, but again, regulatory market fit, so that compliance can be taken care of at the very early stage to avoid this kind of situation while growing further, maybe at much decent level when they are disbursing around maybe at a decent more than 30 CR per month. So when the volume is low, I think it is better to take care of the compliance rather than just going to a CEO or lawyer about compliance. I think specialized, like we are creating risk department, we are creating accounts, finance. I think compliance, specifically compliance department, would be the ideal way to avoid this kind of situation in the coming future.
Mr. Mandal, as a founder of the startup, so you are mentioning creating open-ended ecosystem for the startup. What is this open-ended system, sir?
So open-ended is not an kind of open-ended, but for the fintech ecosystem to create their own self-regulatory organization.
Okay.
Again, this push has been coming from RBI. Mr. RBI Governor has spoken quite a lot on the in the last fintech phase that has happened, I think in the month of September. I think he was quite vocal about why don't fintech founders come up with their own self-regulatory, so that they can work in harmony with RBI and make this ecosystem a completely comply with the regulations and other challenges that is currently being faced by the entire ecosystem.
Good. So this, I think this recommendation, what is the instruction of the RBI, we have to be implemented by 29th February, 24.
We can take it as both suggestion and instruction since,
that's what I'm
yeah.
talking about.
Yes.
So what do you feel that effect on volume of the business and major profit margin?
I think it has already.
How you comment on that?
I think the volume has definitely has been affected by this regulations and compliance,
Okay.
and also the profitability also, because for the end customer, the cost of capital is growing up. Again, we have seen the interest rate has gone up as high as 36%, reducing also from some of the fintech players.
36%. 36%.
Yes, yes, reducing. We have seen that high also. Like I'll not take the fintech platform name,
Yes,
but we have seen
it is simple interest, rate of interest, or something compounded.
No, is the the reducing interest rate, which is normally it's staggering at around 24%, but we have seen as high as 36% for the over leverage customers. But again, this the multiple top-up loan which is giving out to customers, that is ultimately resulting in NPAs.
Okay.
And personal loan NPA is on the rise, and I think on the recent figure, I think it is 100 crore per day. That is why I think maybe the reason of climb down hard on the unsecured finance from the RBI.
Okay. Thank you very much. I will again come to you. Some other points will be there, so I will come back to you. I'm coming to Mr. Madhu Srinivas, who is a partner in Signe, 17-year experience in understanding risk compliance, ex-HDFC Bank, was heading risk and compliance in top banks and fintech co-founder. Mr. Srinivas, this is non-compliance of the RBI. So how the fintech company is responsible? Who is responsible under a fintech company for non-compliance? Have you why these are not being complied by the Reserve Bank of instruction are not being complied by the Fintech or any bank or something like that? Have any view on that, Mr. Srinivas, for you?
Yeah, good evening, everybody. So, Gupta, this is a odd question which currently everybody is talking about in terms of why RBI is penalizing NBFCs, fintechs, and what are those non-compliances which we need to avoid primarily, right?
Okay.
Uh, See, today the hated words in banking or BFSI segment is non-compliance, non-adherence, penalties. People hate to listen to it. So I will just give a brief background about it. See, first we need to understand on why RBI is doing this, right? I have seen these transformations in BFSI segments in last 2 decades, right? For every transformation, there is a reason behind it. Uh, Today we are in a era of digital transformation, right? So every banks are trying to adopt digital transformation systems in terms of it might be onboarding or it might be a monitoring systems or it might be related to your backend processing systems. The banks need to trying to automate their processes currently, right?
Okay.
This is where this transformation is happening. And the answer to your question in terms of why RBI is doing this, let's go back maybe like 5 years back. If you see changes in last 5 years, right? RBI is very aggressive in getting lot of regulations in place. The reason behind this one is it started from ILFS. Okay, this is the history of why RBI is so aggressive, and we need to get in the ground level of why they are doing it. One is the ILFS scam, which is which has opened a lot of doors in terms of control measures. Two, in last 5 years is COVID, which has led to a lot of challenges from a banking segment. And three, in terms of geopolitics, like examples like Ukraine war, and four, in terms of monetary policies, right? These in last 5 years have been accumulated in terms of continuously one or the other things are coming up in last 5 years, which is resulting to tighten our internal system to have a strong economy and ecosystem, banking ecosystem in place, right?
Okay.
So this is what we need to understand, like what exactly, like what is the top reasons for NBFCs today, like in terms of why they are getting penalized or why they are getting non-compliances. So one main reason is capital adequacy norms. They are not following the capital adequacy norms from an NBFC perspective. Two, from a KYC perspective, they don't adhere to the basic KYC norms in terms of whom you're onboarding or sufficient documents not collected at the time of onboarding, right? And three is loans and advances to the relatives or known surroundings of the NBFC management. These are the top three reasons if you filter out in last 2-3 years why NBFCs have been penalized. So there are some basic control measures to be in place in. So today's world, like it's not on KYC or KYB, it is more on, I feel it is more on WIC, that is who is your customer. So gone are the days like know your customer, know your business. Now it's more of who is your customer. Like you onboard a customer, but do you know who it is? Who is he? What business he is into? What segment you are categorizing him as? Or are you monitoring your customers' transactions? Are you frequently, periodically monitoring your customers' credit worthiness? This is what we need to focus on, more on this than on just from an onboarding perspective. I have onboarded a customer and I'm getting my targets done or my lending. You can say it as your sales lending targets are done. Example. So these are primary reasons basically why
Okay,
RBI is doing it.
so you feel that what RBI has done, this is for a Indian economy, it is better for the economy because NPA level for a small business is going up, and we understand. For a small business, I think this is a checklist to arrest the NPA level. Have any view on that? Because you are an expert in the risk management also solutions.
Yeah, so see, this is more of RBI is ensuring that the NBFCs and banks they have no challenges in terms of cash adequacy, number one, and number two in terms of asset qualities, right? Which is a primary focus. Number three in terms of NPAs, right? How to reduce your NPAs. For example, due to these regulations, the NPAs in NBFC has come down from 7% to 3% recently, right? So there are results out of this. And four, in terms of money laundering, which is a primary thing which RBI is focusing on, because a lot of if they term in a joke, like if a Chinese guy wants a loan, he can open a company in India and he can get funds and transfer it to China. Okay, that is what our industry was 2 years back. You can see the companies like Xiaomi or any Chinese related companies, they start a Binomi company in India and they transfer funds to China. I'm just giving an example, right? So if I'm in China, I want to get a loan, I can get it easily from India 2 years back.
So Srinivas, you are also expert in startup. I think you started your own startup, building fraud risk management solutions. Have you, this participant want to know, what are the risk management solutions you have provided to the startup?
See, primarily it all falls down to a certain process, basically, from a compliance or from RBI or from a risk. There's a set of phases. Like one is your assessment, right? So I take it from an RBI perspective. Like whenever RBI gives a notification or a guideline, first we need to assess it. So that is the first phase of assessing a notification or a guideline from RBI. Assessment in terms of priority or the sensitiveness of this notification, number one. Number two, once you assess it, you need to bifurcate into how seriousness of categories like high, medium, low. Once you do this, the second step is mostly on prevention, like how do you prevent this, right? By ensuring new tools in place. For example, the risk tools, what we are talking about, from a KYC perspective, from a transaction monitoring perspective, from an AML perspective, what prevention measures you are. And number three is, and the most important is the training to the entire team for the organization in terms of what to comply with, do's and don'ts. And in today's world, like the 90% of the reasons of penalties or non-compliance is because of one staff mistake at a branch somewhere, or a sales fleet on street guy missing to collect one document. As Keshav was telling, like in terms of multiple PAN cards, right? That is again because of lack of monitoring systems in place. So what we do here is, how we control is basically we support in one in terms of customer categorization. We have solutions wherein it will categorize the customers, risk categorization of customers based on customer credentials and lot of other sources. Two is, we also monitor the customer. We support in transaction monitoring solutions across mode of payment. Let it be a CASA account or a UPI or wallets, crypto. We support in transaction monitoring solutions to identify suspicious and fraudulent transactions, right? To avoid fraud losses. And we also provide AML solutions in terms of sanction screening list checks. In terms of AML, there are specific rules to identify or filter suspicious transactions from money laundering perspective. So these are the solutions, how we support the industries in terms of fintechs or organizations to ensure that they know who is the customer, what is he doing, and what is the right time to block him or allow him with additional facilities or products inside the bank.
Good. So this is last question for you. This is NBFC or Fintech. How they will navigate these changes? Have any idea on that respect?
See, definitely. I've been very practical always. Like, I'll just give you an example just to be more interesting than on our normal topics. See, for example, a traffic regulatory, right? A traffic regulatory says you need to wear your seat belt, or you need to have insurance in place. You need to have your traffic jumps or your speed levels in checks, right? That is where they fine you, they penalize you. But they don't penalize you on terms of whether your vehicle is having a fuel or not, whether your tire has complete air or not, or the tire is completely filled with air or whether it is half filled, whether you are giving your vehicle for service regularly or periodically are you giving your service for vehicle for service. All these are not regulatory, right? But we still do it from a traffic regulation perspective. Why we do it is because there are some basics which we need to follow. So this is related to NBFCs and fintechs also in terms of there are basics which we should follow apart from what the regulation says. Once you onboard a customer, the basics is you should first know who is your customer. Number one, like whether your customer belongs to a high risk category or a low risk category, or whether he's based on his credit worthiness, can we provide him additional products or can we limit his lending facilities? First, there are a lot of data sets available across. The only thing is we need to use technology and ensure that we categorize the customer first. Just doing an onboarding and giving him additional services is not our job. So NBFCs and fintechs has to first primarily see that whenever a customer gets into in terms of tie-up, apart from onboarding, the next step they should do is categorization of customers, right? Number, who is there inside your house? It's basically like you get people inside your house, but you need to categorize in terms of who is veg, who is non-veg, what to serve them, right? So those basics you need to do it practically, which many people fail to do, many organizations fail to do. Once they onboard, they see the customer either at a collection bucket or giving him a new product. These are the two scenarios. Or trace the customer like your Malayas or Nirav Modi's thing. Very simple. So let's stick to the basics of once you onboard, categorize your customer. Number one, periodically monitor customers' transactions, periodically have a check on your customer's creditworthiness. And four is, as I always say, it's not know your customer or know your business. It's mostly on who is your customer. Just have a team, allocate a team only to have a digital systems on to regularly track your customers. Now we have a team for KYC, you have a team for giving additional products to the customers or settlements, lot of that. But we don't have a team to monitor the existing customers, which is very, very important in today's world. This is what NBFCs and fintech should do.
I agree. Thank you. I think you have covered excellently. This how they are facing the issues.
And it's not a rocket science. Like
it is not a rocket science. I agree with you. I agree. There is no point for that. So now I'm coming again to Dr. Jaseen B. Gupta. Jaseen ji, before that, I'm just having one question. If anybody can reply. So there is a GSK Burma, CMA, who will be liable and responsible SRO or fintech if any non-compliance. Have any view, Mr. Srinivas? There is one question. Who will be responsible? Anybody can give a reply?
No, the question is not clear in terms of.
They are telling if non-compliance is there, who will be liable and responsible? Fintech, if a non-compliance by the RBI instruction, who will be held responsible?
So primarily the directors of the company, number one.
Natural.
And as usual, the directors blame on the head of risk and compliance of the company.
Natural. I agree. Definitely, the company is responsible. Who is the owner of the company? They are responsible for non-compliance.
The directors get a notice from RBI.
Any MD or something like that. Who is the helm of affair of the company? They are responsible for that.
Exactly. Today, Mr. Vijay Shekhar Sharma gets a notice from ED and RBI.
Yes, you are right.
Hello? Yeah, I think Gupta ji, the question is more to do with the draft norms which have been provided by RBI on the SROs, the self-regulatory organizations.
Yes.
On the firms. So I think it's still a gray area as to how SROs will function and how fintechs will dovetail into each other. I mean, eventually, I know what Madhu says is very true. I mean, at the end of the day, the owners will be liable, but the SRO will be the governing body, and the norms which will be set out by them will start regulating fintechs, which it will help fintechs assess themselves in their own terms.
But they have already regulated the norms now.
They have. I mean, they have. It is more of fintechs implementing it.
They will have to implement. Now, ultimately, who will be
Correct.
responsible? Responsible will the owner.
True.
But they are not doing it. If I have any view or other view, Mr. Ram?
No, nothing.
Nothing, no? So now I'm coming to you only. Please, at the end, have any your views or any suggestions or any advice you want to give to the participants who is listening to you? Have any advice, Mr. Rao? Last
No,
word?
I think it's pretty much very clear that in coming days, the payment landscape will be very much regulated. The various players inside the landscape will they will have to start buckling their belts and folding the sleeves up and become very serious with respect to all the boundaries that fintech that RBI will put across. And the further investments, when people will start thinking about new startups, they will definitely think about the compliance and the regulatory aspects also before they take the plunge. I mean,
Right.
investors will also start looking at it from a lens where they'll say, I will invest only when you're clear with respect to all the regulatory norms. So I think
Right.
that's the biggest transition, the paradigm shift which we'll see in coming days.
The compliance is a must. Even RBI, all the norms, they must be complied with. There's no point for any complacency as we're talking about the PTM. Now your whole faith is there. So without compliance, it is very difficult to survive also.
Correct.
So I'm now coming to Mr. Mondal. Mondal, have any view, Mondal, any advice to the other participants?
I think the only thing that needs to be taken care of at the very early stage, that is better to comply with the regulators than on the later stage. So there are enough example at the early stage startups that were struggling to comply with the regulations, because there have been a lot of loopholes. Even those who are not owning an NBFC license also, the other segment of fintech startup who are basically surviving on the FLDG arrangements and BC model just to getting a payout and disbursing loan for NBFCs. So I think it's better to have their own compliance infrastructure in place internally than depending any other like single lawyer getting an advice on a regular basis. The time has come for the founders to take it very seriously, because this is a very serious business, and for a long-term decent business, to building a decent and long-term business, it is very important to comply with the regulations and compliance given out by the RBI and other regulatory bodies in India.
Okay, compliance is a must.
Is a must. Other things can be taken care of, but
That's it.
if you fail in compliance, then that is going to haunt.
That is a problem.
Yes, absolutely.
Mr. Srinivas.
See, more than compliance, I see this as I can use the terminology as basics. Let's first, any fintechs or NBFCs stick to the basics of how to identify a customer, or how to categorize a customer, or how to stick to certain regulatories in terms of a checklist, right? That is primarily, you will get it only when you have a strong policies and procedures in place. Somebody has to take an initiative, like as RBI pushes the NBFCs and fintechs or banks to comply with certain regulatories inside an organization. Somebody has to, the policy makers has to implement a clear draft on what to be done, and the entire team should be trained on it. Today, what we are lacking is the training. Everybody is matured enough and expertise enough in terms of how to run an organization or what to comply with. But the guy at the ground level, while collecting a PAN card or while collecting an Aadhaar card, he is not aware that this is an RBI mandate thing. For him, it is like today I do a number, I get 50 rupees out of it. Right? So training is mandatory, and I again always reiterate that ensure the entire organization is well aware of the sensitiveness of RBI regulatories. That is must.
Very nice. Very nice. So I think Dr. V. Gupta, madam, I left. She's there. So now I am end of the session. So we as a researcher in India, we are a merchant banker, we are investment banker, we are a government advisory also. We are giving a training to the banker, and we are holding so many webinars under the different subjects. And our ScoreMe is a fintech company who is analyzing the account statement and doing a KYC. And for 59 minutes, just like we are also doing it, appraisal note for the SME sector. I think that fintech company is also with us. Then we have Association for Financial Advisor, who is helping the financial person and giving the knowledge sharing to these people. In the end, I'm thankful to the person who is off screen, Mr. Rohan, Mr. Joginder, Mr. Lokesh, Mr. Vishwas Chaudhary, and above all, we are thankful to our participants who always give their feedback to us and always informing what type of webinar, what type of virtual session we should hold it. On their request, we are mostly in every week we are doing our such thing. We are thankful to participants. Above all, I am thankful to all my eminent speakers who have spared their times and share their practical experience. I think this session have a practical, as per their experience, they have shared their experiences for that. In the end, so I'm thankful to all my off screen, on screen, and other peoples for that. So with this word, I close this session. Thank you very much, sir. Thank you.
Thanks, Gupta. Thanks, everybody.
Thank
Thank
you.
Thank
Thank
you. Thank you,
Thanks.
everyone. Thank you.
Thank you. Thank you.
Hey, bye, Sudeep. Bye, Keshav.
Bye.
Bye.